Okay, so good evening and welcome to Extra Credit Union's workshop, Homebuyers Workshop in partner with GreenPath. This evening our presenter is Bill Folks. He is our Partner Experience Manager with GreenPath. He has been with GreenPath since 2008. He started as a financial counselor and now he works directly with credit unions to provide financial education in partner with us to help members like you reach your goals. And so we may have some folks trickling in. Obviously in this virtual world, it's a little bit easier for folks to step in when they can. And if of course you need to step out, you can go ahead and do that as well. So before Bill gets started, I just wanted to quickly turn it over to May, who is also in our marketing department with myself, Ashley. She is just going to briefly explain a giveaway that we will have in conjunction with the workshop that's happening this evening, and then Bill will get started with the workshop itself, and then we will have some time at the end for questions as well. So go ahead.
Thank you. Thanks, Ashley. Hello, everyone. Thank you so much for joining us this evening. We appreciate you taking the time to hang out with us this evening. So during Financial Literacy Month every year, we do Financial Quiz Fridays where we'll post a financial related quiz question and offer up ECU swag and gift cards. So every week there's an opportunity for a $25 DoorDash gift card. This time around, it's a different gift card that we offer each time. And during the weeks of the financial webinars that we have during this month, which is this week and next week, the question will be related to the seminar itself. So only the people who are in attendance will know the answers to the quiz questions. So you guys kind of have a leg up on other participants. And this week and next week, it'll be a $50 DoorDash card rather than just $25. So make sure on Friday you jump onto our Facebook page at some point and answer the quiz question. We make it easy, so it's not anything that will stump you. But thank you ahead of time for participating and good luck.
Well, all right, so thank you, Ashley and May. As they pointed out, my name is Bill Folks. I am a Partner Experience Manager with GreenPath. And before we get started, I just want to take just a few seconds to talk about who GreenPath is. GreenPath, we are a nonprofit HUD-approved housing and financial credit counseling service. We started out as the budgeting service for the Michigan Credit back in 1961. We are now a national financial counseling agency. We counsel over the phone in all 50 states and face-to-face counseling in 22 states, but our home is still here in southeastern Michigan. We're headquartered in Farmington Hills. We provide budget counseling and financial assessments. We provide housing counseling, both pre-purchase counseling, which is a lot of what we're going to be talking about today, and delinquency counseling. We offer student loan counseling and budget education and management services. So next, let's take a couple of seconds to talk about our agenda today, the things we're going to be covering during our time today. First, we're going to talk about how much can I afford. That's a question that a lot of times, first-time homeowners don't think to ask before they start the home buying process. So we want to talk about how much can you afford. We're going to discuss what type of cash funds may be required if you're looking to buy a home. We're going to talk about the difference between pre-qualification and pre-approval. A lot of times, some people may think they're the same thing and they're not sure what the differences are. So we're going to talk about what those differences are. We're also going to talk about the process for shopping for homes and loans, some tips to make that a little easier for you. Next, we're going to explain what the closing is and what happens during the closing, so you know what to expect there, so you're not surprised by anything you shouldn't be surprised about. And finally, we're going to talk about some helpful reminders, share some helpful reminders to help you in your home buying process. But first, like I said, let's start with answering the question, how much can I afford? As a rule of thumb, most people can typically afford to buy a home that costs about 2.5 times their annual income. And I said that's a rule of thumb. It's not necessarily a hard and fast rule. Your goal should be really to get the smallest mortgage possible. Every budget is unique. Later we're going to discuss how to use your budget to determine your monthly housing payment and what you can afford. And this monthly figure can be used to estimate the mortgage payment and purchase price that you can handle. But really, once again, you should be that 2.5 times your annual income. That's more of a guideline. You should be looking to get the smallest mortgage payment that you can afford that's going to meet your needs. Let's take a look at some of the costs and expenses that you can expect when you buy a home. And some spending guidelines. Your mortgage payment should be 35% of your pay, of your overall budget. I should say 35% of your overall budget. This includes your mortgage payment and your utilities and maintenance. And if that budget exceeds 35%, which sometimes that happens, sometimes it's a lot less than 35% as well, but if it exceeds 35%, then you need to start considering what areas you might want to decrease, what other categories you might want to cut back on to make up for the fact that you went over that recommended 35%. For example, if you don't have a whole lot of other debt, you can allocate more of your money to housing without much of an issue. Or you can decrease some of your entertainment or transportation expenses, or you may be able to allocate just more money to housing. If your housing takes up less than 35% of your income, that's great because that means you can put more money in savings. Your other limited expenses should be about 45% of your budget. Transportation should account for about 15%. Your debt load should account to about 10%, and your savings should be about 10% of your budget or 10% of your income. Now, buying a home will require some upfront funds, so let's review some important terms about that. One is going to be the down payment. The down payment is part of the purchase price that you pay when you're buying a home, and typically you're going to pay that in cash and either a check or maybe on a credit card. It's not included in the mortgage. It's not included in the amount that you are financing, and we're going to talk about that as well a little bit later on. Next, there's earnest money. Earnest money is a deposit used to demonstrate that you as a buyer is serious about your intent to buy the home. The earnest money deposit can usually be anywhere from 1% to 5% of the purchase price, although that amount can vary depending on your local customs and even who the lender is. And it becomes part of the down payment if the offer is accepted. If it's returned to a seller, it's returned if the seller backs out of the deal. It could be forfeited if the buyer pulls out. So if you make an offer, put that earnest money down, and then for whatever reason you decide to pull out, then you may forfeit that, and that's usually spelled out during the time that you put that earnest money down. Next are the closing costs and settlement costs. Closing costs are customary costs that go above and beyond the sale price, and we're going to talk about that a little bit more later on as well. But then they could include things like attorney fees, title insurance, appraisals, points, which we're also going to talk about, and property taxes. And those things have to be paid to cover the transfer of the ownership at the time of the closing. So closing costs vary also by geographic location, and of course it can vary depending on how much you owe for those things. If you're buying a home and in most instances you're going to be paying back a portion of the taxes that's already paid, depending on what time of year you buy it and how much taxes are paid, could impact the amount of the closing. And finally, your post-purchase reserve funds. That's just a fancy way of saying an emergency fund or savings. The lender's going to want to see that you have some savings to protect against potential cash flow problems after the purchase, or to cover any emergencies. And regardless of what they require, and sometimes your lender might require a certain amount, they might want to see a certain amount, regardless of what they require, if they require anything, is vital. It's really important to have a sufficient emergency fund in place when you become a homeowner. At GreenPath, we always recommend, no matter what, whether you're a homeowner or you're renting or what your situation is, that you have a goal of having 3 to 6 months worth of living expenses put aside for emergencies. That will not only cover you if you have a cash flow issue, but it could also cover, those unexpected things that just happen to come up. About 1.5 years ago, my hot water tank died, and I had to replace it. Thankfully, it wasn't too expensive. My cousin's a plumber, so he actually gave me the friends and family discount. He didn't charge me an arm and a leg to install it, and I was able to get that installed for about $600. But if I didn't have that money in savings, I probably would have had to finance that and put it on a credit card, or depending on my situation, it might not have gotten done. So it's really important that you have that money in savings for things like that. There are some things in homeownership that some people typically forget, and I want to talk about those next. And as you can see, some of these costs may be things that are upfront, and some are costs that might be on an ongoing basis. You're going to want to make sure that you have a cushion for things like maintenance. Or make sure that you know what the property taxes are and that those things are covered. Commuting costs. If you're going to have a significant commute from where your home is, you want to make sure that you're covering those things as well. Make sure you have an idea about how much the utilities are going to cost, and those are things where it might be a good idea to speak with the previous owner. Once again, I'm getting ahead of myself. We're going to talk about that a little bit later on as well. But you're also going to want to figure out how much furniture you're going to need. If you're moving from an apartment, like I did when my wife and I moved from an apartment to the house we live in now, and our house is about twice the size of our apartment. So we had to buy some more furniture to fill some of these empty rooms so that it didn't look crazy when guests come over. So how much is that going to cost? How much are you going to need to cover those things? And once again, these are things that a lot of times first-time homeowners forget about. So we want to make sure that as first-time homeowner, you're not forgetting about those things. Now, in the home buying process, you're probably going to hear people talk a lot about qualifying ratios. In fact, whether you're buying a home or trying to finance a car or lots of different types of loans, you might hear the term qualifying ratios. And what that basically means is they want to know what the ratio is or how your income stacks against your other bills. These ratios are used by underwriters to determine if the potential mortgage amount is going to be affordable for you. If your current ratios are higher than the allowed maximums of your lenders, and that's going to be different once again from lender to lender. In many cases, there's some things that are pretty typical, but if it is higher than the allowable maximums, you'll either need to increase your income or find a way to decrease your debt loads. Now, the housing ratio or the front-end ratio, that's calculated by dividing your potential mortgage payment, your property taxes, and homeowners insurance by your gross monthly income. And here at GreenPath, as counselors, when we're counseling people, we always encourage people to use their net income when looking at a budget. But it's good to know that lenders, for most types of loans, they're going to be looking at your gross income, and so that's what they're going to use to calculate both that front-end ratio and the back-end ratio. And that back-end ratio is calculated by dividing all of your monthly obligations, including that potential mortgage, and any credit cards, student loans, auto loans that you have, and divide those things by your gross income. So for an example, say if you have a gross income of $3,000 a month and your housing expenses are $800 a month and your other expenses are $300 a month, then that means that your front-end housing ratio, or the front-end ratio to housing ratio, is going to be 27% of your income. That's $36,000 a year, $3,000 a month, and that $800 is 27% of that front-end ratio. And when you look at the back-end ratio, what's included with your mortgage and any other potential bills, and that's going to be 37% in this scenario. And a lot of times, many lenders are going to want to see numbers in this area. That's why we use this amount. Now, some lenders might go up as high as 32, even 35%, or at least in the past for that front-end ratio. But typically, it's going to be somewhere around 30% for the front-end ratio, and the back-end ratio around 40% for that. Now, I do want to talk a little bit before we get too much into the process of further into the process of buying a home. We want to talk about the difference between dreams and goals. Because dreams are wonderful, they can inspire us, but they don't necessarily give us guidance. They don't give us the roadmap that your goal would do. Because your dreams might say you might want to be comfortable and travel the world, but that's not a goal because you don't know what you're going to need to travel the world. Whether you retire and you're trying to go to, England or Italy or Jamaica or Greece or wherever. So the dream is, again, this amazing idea, but the goal is your guidance and your roadmap. For example, to clear that up, retire is the dream, but the goal would be I like to set aside $50 a week to prepare for my retirement in 42 years. That would be the goal. In the GreenPath, we like to use what's called a SMART goal. So SMART goals are specific, measurable, attainable, realistic, and timely. And let's just say for the purpose of buying a home, your goal is to have $10,000 put away to cover any closing costs that you might need. And so if you want to buy your home, say this time next year, then you're going to need to put about $860 away each month to reach that goal. So that's a very specific goal of $10,000 as opposed to saying you just want to have money aside for that closing. You can measure that with how you're reaching that goal. And a lot of times it's important to look at whether something like that is attainable and realistic, because while it might be attainable, it may not be realistic. If I were to say, hey, I want to put $800 away each month right now, I mean, I could do it, but it's not realistic because some things are going to be not paid if I do that. And it's important when you look at these goals, when you're trying to set a SMART goal, that we are flexible with it. If you see that it's not really realistic and attainable in the time frame that you put aside, you might want to increase that time frame. So maybe instead of a year, you might say, okay, a year and a half or 2 years. And that's really why it's important that you consider these things before you're buying a home. You also want to make sure that you make budgeting a family affair. And that's something I've always said when I was a counselor, whether I was on a housing counseling session or, it's a counseling for credit card issues. You want to make the budget a family affair so that everyone gets on the same page when it comes to money decisions. And I always like to say that doesn't mean that your kids need to know how much you're making. That's none of their business. I grew up in a house and we were pretty old school, and my parents didn't necessarily talk about that, about money. They made sure that we understood that, there are things that need to be paid for, and that we can't always just do what we want when we want it. And to track your expenses, to make that easier, there are budgeting programs and budgeting sheets that we have that makes that easier for you. So, for example, in this example here, track your expenses. This person, if $115 is what this person expects to spend on their electricity each month, but tracking shows that $140 is what they actually spend. That means that the spending would need to be decreased by about $25 in order to reach that goal for that spending on the electric. So that doesn't necessarily mean they're going to need to cut out more lights, although hopefully they can. But it might mean, okay, maybe I need to cut back on some of my streaming services if I'm finding that going over that budget is causing a hardship. And so for more resources, for like budgeting resources and tips and tools, you can go to greenpath.com /university /resources. There's a section of our website called GreenPath University that has tools and worksheets and mortgage calculators and things that you can use. And speaking of mortgage calculators, as you get a better idea of your budget, you can more accurately estimate how much of a housing payment you can afford. So, for example, let's say you're paying $1,200 a month in rent, and you think you can afford a mortgage payment of $1,800. So subtracting two, that leaves a difference of $600. Try to put that aside each month in savings. Not only will it help you pay for your down payment, but it'll give you an idea of what it's going to feel like when you're making that $1,800 payments. If you find that you're struggling to afford this, then you might need to reduce your target monthly payment. We have calculators online at GreenPath University, and actually you can find mortgage calculators probably at the credit union website and many places online that's going to help you determine your mortgage amount and purchase price based on the monthly housing payment you can afford. The calculator is going to ask you for an interest rate, and for now, do your research on what interest rates are going to be. Search for interest rates, maybe on bankrate.com, or maybe ask your credit union what their average interest rates are. And later, as you talk to mortgage lenders, you get a better idea of what the rate is that you might expect. When it comes time to look for your home, you're going to want to get pre-qualified or pre-approved for a loan. And once again, a lot of times people are confused by that. They think they're the same thing. So I want to take just a couple of seconds to talk about the difference between pre-qualification and pre-approval. Pre-qualification is an informal determination of the maximum amounts you can borrow. So there's no commitment there of giving you that loan. It's going to use your housing and debt ratios that we talked about earlier. It can be done over the phone, or it can be done in person, or a lot of times it might even be able to be done online. It may not require a credit report or form application. Sometimes it will. And once again, there's no guarantee of financing, but you still need to go through the qualification process once it's time to be approved. Now, pre-approval is a formal commitment of the lender to loan you up to a certain amount. Now, once again, I want to be clear, that's still not approval for the loan, but it's approval as opposed to the pre-qualification where they say, okay, this is about how much you can borrow. The pre-approval is a commitment to the lender that if you're approved for the loan, this is the amount that they're going to offer. Typically, that offer stands for a certain period of time, and they'll let you know what that is ahead of time, usually 60 to 90 days. There may be a fee for pre-approval loans, and you still need to meet the qualification requirements at the time of purchase. Now, it's important to note that neither pre-approval or pre-qualification are formal loan approvals. That pre-qualification is just a commitment that this is how much we are going to loan you if you qualify, but it's still not a loan commitment to that loan. You will still need to show your proof of income when you actually apply for the loan. However, assuming nothing's changed since you got pre-approved, the lender, the credit union, the bank, whoever you're dealing with, is very likely to offer those same terms that they discussed. So that's why it's important that, once you get pre-approved, that you try your best not to change anything that was included in that pre-approval. Don't go out and buy a motorcycle or buy a new car if you're being pre-approved for the loan, because that could change things a lot. Now, there's not a lot of difference between a pre-qualification letter and a pre-approval letter. You'll often get a letter noting that you were pre-approved. And while there are some legal distinctions, in practice, both terms refer to a letter from a lender that says the lender is generally what the lender is generally willing to lend you up to a certain amount and based on certain assumptions. And to get more information about that and see maybe a sample of the pre-approval letter, you can check the Consumer Financial Bureau's website at consumerfinancial.gov, and that's the CFPB, the Consumer Financial Protection Bureau. Check their website, and you can find the difference between a pre-qualification letter and a pre-approval letter if you're so interested. Now, notice that we're talking about shopping for the home after we've determined what our budget is. And no matter how much the lender says you can afford, keep in mind that the realistic budget that you've developed that we talked about earlier, the mortgage company, the credit union is going to approve you for a loan based on the amount of debt that you have, but they don't look at your whole budget while they're doing that. So, and that's going to include things like your groceries, your entertainment, your clothing, et cetera. That being said, you may get approved for more than you can realistically afford. So trust your gut and your budget when shopping for your home. Now, when it comes to buying a home, most families, their wants far outweigh their needs. It's unlikely, but not impossible, that you're going to find your dream home right away, and that's going to be easy to locate. When my wife and I bought our home, we looked at 34 homes. We actually, it's funny, we recently, for whatever reason, I don't remember why, we looked at the the listings for the home, we kept those, and we looked at 34 homes before we found our home. So it's real important to be flexible when you're searching for a suitable home. You might decide that, you know, there are some things that are deal breakers for you, and some things are things that you might like but don't have to have. When we bought our house, I really wanted an attached garage. The house we have does not have an attached garage, but, you know, that was not a deal breaker for us. So it's just important that you be flexible on certain things and figure out what things that you can afford or are willing to be flexible about. Now, when it comes to negotiating a deal, a lot of times people aren't aware that you can actually negotiate the deal when you're making an offer on a home. And what we actually mean is that, you know, it's important because a lot of people don't recognize you can do that. For instance, you can offer a different purchase price for a home. So just because the seller is asking for $200,000 doesn't mean you have to pay that. You can counter offer and say, okay, would you accept $180? And they can either say yes or they can say no. Or you can negotiate for a home warranty or a warranty on the appliances. When we bought our home, when we looked at the home, we saw that, you know, some of the appliances were kind of old, and although we had planned to replace them, and we have replaced them since then, we asked the seller for a home warranty for those appliances, and they agreed to that. If you are going to pay the full price, maybe you want some of the furniture. I have a coworker who recently, within the last couple of months, she just bought a new home, and her husband really liked the furniture that was in the house, so they negotiated with the seller, and guess what? They were actually able to get them to include the furniture in the house. Now, in this case, they had to pay a little bit more than what they were asking for because the seller was expecting to take that furniture with them, but they were able to negotiate that. So, you know, there are certain things that you can look at when negotiating the deal and make sure that you're talking about that with the seller. In addition to those things that you can negotiate, you do have to make sure that you're considering things like the inspection, and you might negotiate the home based on the inspection. You might have a contingency to say, okay, if there are problems in the home that were revealed by the inspection, that you're not going to be obligated to buy that home. Even if you put that earnest money down and made agreements, you can put that as part of the deal that the price of the house could be contingent on that. The same thing could go for contingency clauses for selling your present home and getting an appraisal that's going to support that purchase price as well. So, you know, a lot of times if you're buying a home and you're moving from a home you already owned, then you definitely want to make sure that you sell that current home before or shortly after you buy the home. And finally, you might want to negotiate and ask the seller to pay for some or all of the closing costs. The benefit for the seller is that it might mean selling the home faster, and of course for the buyer, it means that you're not paying those closing costs. And once again, when my wife and I bought our home, we bought our home in 2005. We didn't even have to ask. The seller just threw it in there. They offered, hey, listen, we'll pay up to, I think they said up to $3,000 of the closing costs, and that made things a lot easier for us because that was $3,000 that we didn't have to worry about coming to closing with or rolling into the mortgage. Now, one of the most important steps in the home buying process is finding the right loan. And let's take a look at some of the different types of loans. A conventional loan is a private sector loan that is not guaranteed or insured by the U.S. government. Traditionally, a conventional loan follows the guidelines set forth by Freddie Mac or Fannie Mae, and those are agencies that have really set the standards for a lot of the conventional loans. So often, if you're looking at a conventional loan, you're going to be looking at loans with guidelines set by those two organizations. There are also established guidelines for borrower credit scores, income requirements, minimum down payments. For example, most conventional loans may require somewhere between 5% and a 20% down payment. The loan may also require a minimum credit score. And if your credit score is below a certain level, your lender may start adding additional fees. Typical fixed interest rates have a term of 15 to 30 years, A shorter-term loan usually results in a shorter interest rate. Conventional loans can also be conforming or non-conforming, and sometimes what's considered conforming or non-conforming might vary from location to location. So loans above the lending limit set by Freddie Mac and Fannie Mae are called non-conforming or jumbo loans. So conventional loans are conforming if they generally meet $417,000 or less for a single-family home. But like I said, they could also be different depending on where you live. So if you live someplace, if you're looking to buy a home at someplace like Alaska or Hawaii or California, where it's typically more expensive, then those limits for a conventional home might be a little bit less. And, you know, let's take a look at FHA loans now. FHA, or Federal Housing Authority, offers government-backed mortgages through approved lenders. FHA mortgages let you borrow up to 95% of the mortgage, of the price of the house, which really makes it easier for first-time home buyers or those who might be low income or those who just don't have a whole lot of money to put down on a home. Those FHA mortgages, which have rates that are set by FHA, and once again, those mortgages are backed by FHA, can be a real game changer and allow people to get in a home without as much paying down. The Veterans Administration, VA, guarantees mortgages for veterans of the armed services, both those who are currently serving and those who have left the service, and the spouses of veterans. VA guaranteed mortgage guidelines are similar to FHA requirements, except loan-to-value ratio of 100% is allowed by VA loans. That means you can borrow up to 100% of the value of the loan without putting any money down, in some cases, VA loans. The downside to that is the less you put down, the higher your interest rate might be. So you might be paying more interest, in interest on that loan, but it could be worth the payoff for you if that means you don't have to put anything down, especially if you're not able to put anything down. Then there are rural economic community development loans, or state finance agency development loans. And a lot of times, when I was a counselor, I saw a lot of times the SBA rural development loans, and that name is a little bit of a misnomer because a lot of times I saw people with those type of loans in places that were definitely not rural. They were urban areas. But the rural development, those loans administer several programs for low to moderate income families who want to buy a new or existing home. A lot of times in rural areas are, once again, the places that may not be so rural. But once again, it really helps those low to moderate income people buy homes. And then, of course, there are state and local governments. Many offer homeowner programs for lower income and other underserved households. These programs offer local flexibility and have favorable underwriting and prepayment terms. Many lenders will offer all of the loan types we discussed, so they can review the pros and cons of each one based on your situation. But those state and local government programs might once again include things like the Michigan State Housing Development Authority. Most states, I think all states, have their own housing development authorities, and most of them offer some types of loans. Even in certain cities, I live in Southfield, and at one point, I don't know if they do anymore, but at one point, Southfield was part of a program that offered down payment assistance if you completed certain education and certain steps before you bought the home. So those are things that your lender can help you learn more about if you're looking to buy a home. Next, we're going to talk about some of the features of a loan. So a fixed rate loan has a locked interest rate, a fixed principal payment, and will completely pay it off over a specific period of time, typically 15 or 30 years. At least when I bought my home, it was 15 to 30 years. Now you see them for time periods that were not considered conventional back in 2005 when I bought my home, but which are considered conventional now. Sometimes you'll see fixed rate loans at 30 years, and I've spoken with people who had fixed rate loans at 40-year terms. But still, even though there's been more flexibility, most fixed rate loans are going to be 15 or 30 years. An adjustable rate mortgage, or an ARM, is generally a 15 to 30-year loan. But once again, those can be, there's a little bit of variety sometimes in there as well. But it's a 15 to 30-year loan with the interest rates that fluctuates or adjusts periodically based on market conditions. And the time between interest rate adjustments will vary based on the details of the loan, and the fluctuating interest rate can cause the total mortgage payment to increase or decrease, and that's really tied to what the interest rate is. And the interest rate on an ARM is often lower at start because of a fixed rate mortgage, and that's because the borrower is assuming some risk there, and that's the risk that the rate could increase and their payment could increase. And so, as a way of enticement, a lot of times that initial interest rate is lower than, say, on a fixed rate loans. Unfortunately, many borrowers are caught off guard when they don't pay attention to details about mortgage payments and the interest adjustment periods. When I first started counseling back in 2008, I spoke with a lot of people who had no idea that they were in interest adjustable rate mortgages, or sometimes even interest-only mortgages. So you should be aware how often your interest rate's could change, and how that the maximum limits of any potential adjustments and how those things could impact it. And finally, there's the hybrid or convertible rate mortgages. And convertible mortgages typically have a fixed interest rate for 3, 5, or 7 years, and then after that, it goes to an adjustable rate mortgage. When I first started counseling, I spoke with someone who had a situation just like that. They had a hybrid convertible mortgage, but they didn't know they had one. And thankfully, they found out before it started adjusting, so they were calling to get education on that. I think that it was a 5-year convertible, and after that 5th year, it was going to start fluctuating. And after that, once again, the loan turned to an adjustable rate mortgage. And like the ARM, this mortgage also includes lower interest rates in the early years. However, the unpredictability of those interest rates in time could result in a higher mortgage payment when the loan is converted to an ARM. Now, your housing payment will almost always include more than just the principal and the interest. This is more likely it's going to include the escrow. There was a time when it wasn't a given that your mortgage payment would include an escrow. These things is almost unheard of for it not to be included in there, or at least for the mortgage company to assume it. And an escrow account, if you don't know what that is an account that's separate from the mortgage account. Is where you're going to deposit funds for payment of obligations that apply to the mortgage, such as homeowners insurance and property taxes. Your mortgage company has a stake in whether your homeowners insurance and property taxes get paid, because if you're not paying things like your property taxes, the state could take your home and foreclose on it for those property taxes. Actually, before I came to work at GreenPath, I worked for the city of Dearborn in the treasurer's office, so that's something I had learned quite a bit about in my years working there. And one thing to keep in mind is that your property taxes and homeowners insurance, they probably will be, they're going to be changing. It's likely to increase, but it also could decrease. A lot of people who bought their homes around the time that I did, 2005, that was right before the housing crisis happened. We lost a lot of value in our homes, but the advantage to that was that, my taxes actually went down, and so my mortgage payment went down. And so that could change your monthly payment, even if you have a fixed rate mortgage. Now the economy is doing a lot better, even though we're a COVID land, the economy is doing a lot better, and taxes are definitely going up more often than they're going down. Private mortgage insurance is another thing that you should be aware of. Conventional and FHA loan mortgages may require private mortgage insurance, actually typically require if the loan-to-value ratio exceeds 80%. So in other words, if you're buying a home for $100,000 and you're not able to put at least $20,000 down on the home, then you're probably gonna have to pay PMI. And PMI's insurance, once again, private mortgage insurance, is written by a private company and protects the lender against the loss if the borrower defaults on the mortgage. So once again, it doesn't protect you; it protects the lender, and this is usually going to be included in the escrow amount. When it comes to comparing lenders, you are definitely going to want to consider what their requirements are, such as a down payment. Those requirements may vary by lender, and as we've seen, depending on the type of the mortgage product you have, your minimum down payment could be as little as 0 for, say, a VA loan, or as much as 20% higher or more. Are there going to be discount points? A discount point usually costs 1% of the loan amount. So if we want a $70,000 loan, a point will be $700. And for each point purchased, the mortgage interest rates usually drops by about 25 basis points, or 1/4%. So for example, if you want to buy one discount point on a mortgage with an interest rate of 5%, if the discount point would decrease your mortgage rate by to 4.75. So instead of 5%, you'll be paying 4.75% on that mortgage. The more points that are required, or the more points you pay, the more cash is needed at the closing, because those discount points can't be financed, can't be rolled into the mortgage. You have to pay them up front. And when considering discount points, be sure to calculate if this is going to be in your best interest, and be aware that, you know, lenders can charge excessive points and rates. The annual percent rate, or the APR, is the total yearly cost of the mortgage stated as a percentage of the loan amount. The APR is a better source for comparison of mortgage costs than the interest rate alone. The APR is generally higher than the interest rate because it also includes the cost of points, mortgage insurance, and other fees included with the loan. So question to ask is, do you know the criteria of the lenders that they use to determine eligibility for your loans? If you've never been through the process before, if you've never bought a home before, it's important to note that some of the things that you're going to be looking at. Of course, they're going to look at your overall income. They're going to be looking at who you work for as well sometimes. Some lenders may have, or some communities may have special loans for first responders or teachers, or other types of loans based on what type of work you do. They're also going to be looking at different things like that. So the criteria can actually be different. So it's important to note that depending on what you're interested in or looking at evaluating, a lot of things that you might not think make a difference could make a difference. The lenders also going to want to know about your stability of income. How stable is your income? A long work history, if you've been working for your employer for a long time, shows stability. If you've been working constantly over the years, even if you switch employers, it shows stability. If you're self-employed, the lending institution might require previous income tax returns and financial statements for a business, or if you're someone who's on commission only, they're going to want to see, once again, maybe income taxes or something just to see how stable that income is, even if it is, say, commission only. They're also going to want to take a look at the adequacy of the income. And, you know, the lender's assessment of risk is going to be measured by determining whether or not you have the adequate amount of stable income to cover the mortgage payment. In simple terms, can you afford it, or do you have enough money to pay the mortgage? Your mortgage income, your monthly income should be high enough to cover mortgage payment without causing a financial hardship. And also spaciously closed as another factor the lenders is going to look at. And, you know, the source and the adequacy of your funds to close the mortgage. Keep in mind that you are prohibited from borrowing money to close on a mortgage without full disclosure of these intentions to the lender in most cases. If you're using gift funds from a family or a relative, the lender may ask for documentation from the individual providing those gifts. And finally, credit worthiness. That's a detailed examination of your credit report, and we're going to talk about the credit report next. That's going to reveal the likelihood that you're going to repay the lender. Your credit report is analyzed to determine your payment habits and past patterns in meeting your financial obligations. And basically, it's once again, the credit report is used to determine what type of individual you are when it comes to paying your bills. Do you pay them on time? Do you pay them regularly? Do you pay what you owe? The credit report can help the lender figure those things out. The best place to review your own credit report is annualcreditreport.com. It's the website that was set up as a result of the Fair Credit Reporting Act that states that you're entitled to receive a free copy of your credit report each year from each of the 3 credit bureaus. Now, the score is never going to be free, or rarely going to be free. You're going to have to pay for the score if you want it, but you're entitled to 1 free copy of your credit report each year from each of the 3 credit bureaus. And right now, because of the pandemic and everything that's going on, the credit bureaus are actually allowing you to get one free copy of your credit report each week from each of the 3 credit bureaus. And initially when they announced that, it was supposed to go through April of this year, but recently they just extended that they're going to be doing it indefinitely. So at some point it will be ending. It's just not ending in April as they initially said. So be sure to check out annualcreditreport.com. Make sure that you're not going to, one of the dummy sites or the copycat sites like freecreditreport.com. That's free. If you want to go to annualcreditreport.com and make sure you're typing it in the actual address bar, not the search engine, because if you're typing it in the search engine, the first couple of results that pop up are probably not going to be what you're looking for. So just for your information, we're going to talk a little bit about how your credit score is calculated. Oops, got a hit there. We're going to talk about how your credit score is calculated. 35% of your payment history, your credit score, I should say, is 35% of your payment history is included in your credit score. Most people are not surprised to learn that your payment history, how well you're paying your bills, are important to your credit score. But a lot of times people are surprised to see that it's so much. So 35% of your payment history is your credit score. So that's why we spend so much time as counselors telling people you make sure you're paying your bills on time. It's it's the probably most important thing you can do as far as establishing and maintaining healthy credit. Next is going to be credit utilization. How much of your available credit are you using if you have unsecured debt? So a general rule of thumb is for unsecured debt, your credit cards or any revolving accounts that you have, you don't want to be using any more than about 30% of the available balance. Once you of your available credit, I mean, and once you start getting above of that 30%, then your credit score could start going down. It'll definitely start going down once you get above 50%. So say if you have a credit card and you have a $1,000 credit limit, ideally you don't want to be spending much more than about $300 or carrying a balance of about $300 on that credit card. The higher you get, the more likely it's going to impact your credit score. They're also going to want to see the length of credit history. And actually, I like to say that the length of credit history and the types of credit used, they kind of go hand in hand, because they want to see how long you've been paying bills, how long you've had credit, but they also want to see that you've been responsible with different types of credit for a long time. So that could include, financing a car by the time you're getting ready to buy a home. Have you been paying your credit cards as well? Maybe if you have a student loan, have you been paying those on time? So the length of credit history and the types of credit are going to be real important. And finally, new credit. What type of new credit that you're applying for is going to be an impact. If you are applying for a lot of credit over, say, the last 6 months, if you've applied for a lot of credit, that sends up a red flag in the eyes of any lenders. It doesn't necessarily say you're not getting a loan, but they are going to know, well, why is this person applying for so much credit? Are they in trouble? Is there something going on that's going to make it less likely going to be able to pay for that home? So these are the things that go into your credit score. Next, we want to talk about the closing. Fast forward a little bit, we're going to talk about the closing. You've been approved for mortgage and you're ready to sign all the documents to close on a home. Let's talk about what happens with that. The closing, it may take place at the title company or at the office of the seller or buyers or lender's attorney. Actually, the last time I refinanced my mortgage, the closing actually took place here at my home. The title agent came to my house, and we sat at my kitchen table, me and my wife, and we spent about 20 hours signing papers. It wasn't 20 hours, I'm exaggerating, but it does seem like you're signing documents for a long time. And there's a closing disclosure that you're going to be able to have access to beforehand. It's designed it is really helpful in helping consumers understanding the cost of the transaction. And this must be provided to consumers 3 days before they close on the loan. And reviewing this ahead of time will allow you the ability to process the information and decide what questions you want to ask. And you just want to make sure that you prepare those questions. And don't be afraid to ask those questions. You might be working with a particular lender or bank, and when it comes to things like that, they might actually do the closing, but typically it's going to be a title agent. And everyone's a little different. And again, a lot of what we're talking about right now, and I should have pointed this out beforehand, these are generalized guidelines. This isn't necessarily anything that Extra Credit Union does or anything like that, but these are general guidelines. And it's just something to be aware of as far as, the closing is concerned. But once again, be sure to review that closing disclosure and make sure you have any questions that you have for the attorney or title agent or who's ever doing that closing. Read all the documents before you're signing them. And I know it's a pain in the neck sometimes, but a lot of times people found themselves surprised when they in their mortgage because they didn't read through the documents thoroughly. That underscores why the law requires that you receive certain documents in advance. But even when you're in the closing office, take time to read them and make sure that you're understanding everything and clear on everything. I mentioned that I used to work for the city of Dearborn. I worked in the treasurer's office, and a lot of times people were surprised that, and here in Michigan, you get your tax bills every July and every December. When they close on the home, it's that say if it's right now it's 2021, the 2021 taxes are paid in full. What most people don't realize is the tax year starts in July. So July of 2021 on the calendar is actually the 2022 tax year. And so conceive that, because I've seen it when I was working in the treasurer's office, people will get their they do the closing, it shows that the 21 taxes are paid in full, and they are, and they're surprised when they get that 2022 tax payment, tax bill, and a lot of times that closing disclosure, it'll tell you that the taxes are paid through June 30th, but a lot of times people don't read that. So that's just one example, just from my experience, why it's important to read that closing disclosure. And once again, be courageous. Don't be intimidated by a closing agent. Not that, they're going to try to intimidate you, but take all the time you need and ask questions if you don't understand something. As we wrap up, I want to share a few final helpful reminders, because we are getting ready to wrap up here in a few minutes. The best source of income regarding continued maintenance of your new home is the previous owner. So if possible, go through each room with the seller before you close on the loan and become familiar with aspects of the house. They might be able to, tell you things like when the water heater was replaced, when the furnace was replaced, how old the roof is. You're going to want to make sure that you get a chance to chat with the homeowner. Also, before we move on to reviewing the home inspection report, try to chat with your neighbors as well if you can. Try to find out, what type of neighborhood it is, why they like living there. If you're speaking to the owner, previous owner, why are they selling? Why are they leaving? It could be something, something personal. But if there's a reason like, oh, there's a fire truck that comes screaming down the street every night at 3 a.m., you might want to know that. Make sure that you review the inspection report, because you may not always be able to speak with the previous owner, especially if that previous owner is deceased, or say if they've moved away and they're selling the home in absentia, they're selling it because they're just not there anymore. It's important to read the inspection report. There are lots of reasons why you might not be able to speak with the previous homeowner. Maybe the home is foreclosed on. Who knows? But if you're not able to speak with the previous owner, review that inspection report. That's going to tell you a lot about the condition of the home. When I bought my home, the inspector was able to tell us, that the roof we had was in pretty good shape, but we're probably going to need to replace within the next 5 years. And sure enough, about 5 years later, we were replacing the roof. So, that inspection report can tell you things like that, let you know what to expect, and make sure that you're ready for those things. You also want to make sure that you're saving for maintenance. When you're preparing your annual budget, you want to estimate how much you're going to need to spend on maintenance. A typical rule of thumb is, 1% of the value of your home per year for that you're going to spend on maintenance. So divide that number by 12, and that's going to let you know how much you're going to need to put away each month for that, for maintenance. But you do want to make sure that you're saving for maintenance. Also, be sure to get sufficient homeowners insurance. When my wife and I bought our home, we shopped around and spoke with several companies for homeowners insurance. One of the first ones we spoke with, it was a ridiculously low payment that we were going to be making each month for that, and we were like, okay, what's the catch? Well, thankfully, my wife is an insurance professional. She's been working in insurance her entire adult life. She knows how to read policies, and I don't know if I'd have caught this, but the policy that we were looking at only covered about 80% of the value of the home. So we passed on that one. So just make sure that you are getting sufficient homeowners insurance, something that's going to cover the full value of the home, or at least the full cost of the home if something happens and you need to use that homeowners insurance. And finally, remember to be a good neighbor. You know, a neighborhood is a wonderful place, and you're a big part of it. And the work that you put in being a good neighbor is going to help maintain the quality of your neighborhood, maintain your house and your yard and your front walks, and get involved. Participate in homeowner associations if they have one, and maybe the neighborhood watch groups or any other groups. And most importantly, enjoy your new home. We hope that you found this information useful. I'm going to take Ashley and May off mute in just a moment here. But if you do have questions, if you do want to speak with a financial counselor, you can reach out to GreenPath at 877-337-3399. Once again, GreenPath is a national nonprofit that provides financial education, but we are headquartered right here in Southeastern Michigan. Thank you for your time, and you all have a great day.
Thanks,
and
Bill.
Ashley and May. Okay.
I think I'm off mute. Thank you. Thank you so much. Yes, that was definitely some useful information. I myself even learned about the changes in annualcreditreport.com and being able to access your credit report more frequently. So I personally do use annualcreditreport.com to review my personal credit 3 times a year, and I was not aware of the changes due to the pandemic and being able to access the report more often. So thank you for that tidbit of information. I just also wanted to note that you mentioned refinancing your own home and having the title agent come to your home, and I'm actually in that same process because the rates are at a historical low, which is awesome for folks that are looking to buy for the first time, or even current homeowners that would like to refinance to take advantage of the lower rate. So I have my closing to refinance next week, and they are coming to my own home, which I thought was nice. So it saves me 1 trip. So I will sign those 20,000 documents that you mentioned myself and save myself a little bit of money with the rate going down. And just a reminder, Extra Credit Union does offer both mortgages and home equities. We actually have a current promotion taking place now. So you can obtain a $50 Lowe's gift card if you close on a mortgage or a home equity loan with us during the promotional period. So just wanted to add that tidbit of information. But I also wanted to just let folks know that we have one more workshop with you, Bill, next week. So next Wednesday, same time, 6 p.m. And the next one is going to be not about buying a home, but instead it's about how to reduce your spending. So if you're thinking about buying a home in the future, whether it's in the near future or a little bit farther away, of course, how to reduce your spending might be something that you're interested in so that you can start to save for that down payment or build the emergency fund in your own account. So some of the things that will be covered in that workshop next week are easily overlooked budget items, forming new habits, reducing decisions that you have to make in terms of spending money. And of course, you will provide folks at that webinar with some steps to take to be able to make that happen. So I appreciate all of your time, and thanks for those that were able to attend this evening. And I look forward to having the workshop next week. And I wasn't sure if, May, you want to add anything or if there were any last minute comments or questions, but I appreciate you taking the time, Bill, to be with us this evening, and thanks for the information.
Thank you.
No, I don't have anything to add, just excited for those who joined us tonight and participated, and hoping to see you all next week.
All right. Well, thank you for having me, and everyone have a great day.